So big investment banks report the last earnings for 2013 next week. It doesn't seem like it's been the greatest year, which means the bankers won't get paid so much.
Yeah, exactly. Just judging by how the fourth quarter's gone and then extrapolating from the first 9 months of the year, it may well be that bonuses are slightly lower for most of the banks than they were. Or at least the total compensation pool is lower than it was in 2012, which wasn't a great year either. Don't forget the banks haven't been earning great deals of money, at least on return on equity. We look at their billions of dollars of net income, think, my God, that's huge. But return on equity is pretty poor. They've been taking steps like Goldman and others to reduce costs, like bonuses to increase return on equity.
They've been more attuned to kind of getting the comp to revenue ratio down. I mean, it's still not
well,
maybe
and
as low as it
down
could
so that the balance with the return that the shareholders get is a little more even with what the bank
exactly.
Which has gone way out of whack, but it's definitely more.
Some of them haven't. I mean, Goldman Sachs was a bit slow to change, at least during the course of the year. At the end of the year, it would often bring down a bit, but it was normally around 42% of revenue, the comp. And that's come down to the high 30s.
Which is fine if you're making massive returns.
Yes, but it's not when your returns are just hovering around the covering your cost of capital level.
But the saving grace here, of course, as you point out, is the stock prices of banks, which have done phenomenally well over the last couple of years.
At least all the senior bankers are paid about half often in stock.
Absolutely. You think back before the crisis, everyone used to get a fair amount of cash in their bonuses, maybe some stocks, some of which you could probably sell in the first year or so, but a lot of it, maybe 25% was deferred. These days, it's at least 50%, it seems. And Morgan Stanley last year, don't forget, said everyone earning over a certain amount on bonus had everything deferred. So that means you had nothing coming into the bank.
And if you had stuff deferred 5 years, you're getting the last batch of crisis stock, and the stocks are way higher now than then.
Yeah, so if you worked at Merrill or now B of A, and their stock is what, like tripled?
Their stock has tripled in the past 2 years. So those are sitting on, who are now able to sell some of their stock from their 2011 bonuses, are going to be thinking, this is great. And if you're at Morgan Stanley or Citi, I think it's doubled in those 2 years. And even if you look at last year, Morgan Stanley might be able to sell some of their stock employees from this time last year, and they're up 56-60%. So the big juice, the juice these days from bonuses seems to come from pay that has been deferred in previous years as a result of deferrals having to go up after the crisis.
Right, they won't be getting such big bonuses, but at least they'll feel warm because of what's coming from previous years.
Exactly, because at the moment there's not a great deal of joy coming from the future. Now, some parts of the business are doing well. Equity capital markets is doing well, for example. But if you look at where earnings are going, most investment banks aren't looking at a huge amount of revenue increases. Morgan Stanley might have a good set of earnings, mostly from wealth management. So what do? You think, well, I might get a bit more in the future. But investment bankers, especially the executives, have been saying over the past few years, look, we know we're not cutting costs on bonuses as much as maybe revenue's falling, but don't worry, when revenue goes up, bonuses won't go up as much.
Wow.
So we've got to make sure they stick to that.
Okay, we'll keep a long-term eye on that. We'll leave it there. We'll cover all those earnings and pay numbers next week, and we'll have more breaking views for you tomorrow.